Hello and welcome to CrypTalk. I'm Ross Sinclair for BizNews.com, and I'm joined by Gaurav Nair of Jaltech. Just a reminder that nothing said in this episode should be taken as financial advice, and please speak to your financial advisor. So quite a lot has happened since we last spoke. Before we get into all the juiciness of FTX, I'd just like to talk about crypto now being recognized as a financial product in South Africa, what it means for consumers. Will it change the nature of cryptocurrency, and how does it protect people?
Sure. Yeah. So one of the reactions of the regulator, FISCA, saying that crypto is now recognized as a financial asset for the purposes of phase, a lot of people started to believe that this means that financial advisors can now sell crypto assets or advise on it or intermediate their sale. And actually, what was the case beforehand was that it was unregulated. Anyone could do it beforehand. Now, by FISCA bringing it into phase, it means it's now a regulated activity. And the consequences were that most financial advisors were quite nervous to actually sell or advise on crypto assets, even though it was unregulated and anyone could do it, because it wasn't regulated. And now that it's actually regulated, many financial advisors are dipping their toe in. They've been facing demand from some of their clients. They have sometimes themselves seen a position in certain clients' portfolios for crypto, an allocation. And now that it's regulated, the advice or intermediary services on crypto assets, they're actually getting more involved in the space.
So now on to FTX. So it was the second largest trading platform by volume. They were the sponsors of the Mercedes-Benz F1 team. They held a stake in Robinhood, the stock trading app. Sequoia Capital had a large stake in FTX. They had celebrity ambassadors, Tom Brady, his ex-wife now. Kevin O'Leary was an ambassador for them. Their founder and CEO, Sam Bankman-Fried, was always almost seen as like a messianic figure inside of the cryptocurrency world. It seemed almost too big to fail, and yet it was so catastrophic. What exactly happened, and how did this all fall apart?
Yeah, Ross, I've got to tell you that this took me by surprise too, and it felt like a personal betrayal, even though I myself and Jaltech didn't have any exposure to FTX, just because of the type of personality that Sam Bankman-Fried had. He seemed to be one of the only responsible players in this space. As you had many other big personalities and their various funds and exchanges blowing up, FTX and Sam continued on. His hedge fund, Alameda Research, also continued on and didn't seem to have blown up earlier in the year when all the other funds were. And then FTX and Sam were going about rescuing some of these other exchanges and institutions that had become insolvent. And so it seemed like Sam was the savior of crypto. And then furthermore, Sam was lobbying in Washington, D.C. for crypto regulations. And at the very end, it seemed like potentially he was actually lobbying just to entrench FTX as one of the biggest players and actually block off other players from coming in. However, before that, he was seen as someone who was fighting for crypto's interests in Washington, D.C. And there was a bit of a spat on Twitter between Sam and the founder and CEO of the biggest exchange by volume, Binance, a guy named Changpeng Zhao, or CZ, as he's known in the crypto circles. And through this spat, it seems like CZ triggered a run on FTX. And now, normally, a bank run is a scenario where all the depositors come to the bank at the same time trying to withdraw their money. And for a bank, it kind of makes sense because they've taken deposited money and made loans to other people. So they don't actually have the money there, which is fine as long as not everyone comes at once. However, with an exchange, a run shouldn't be possible because exchanges shouldn't be taking their clients' money and lending it out. If people have deposited crypto or bought crypto on the exchange, it should just be there. It shouldn't be anywhere else. Um, However, as people started withdrawing their funds from FTX, FTX then paused withdrawals, of course, indicating that they didn't have the liquidity that they should have as an exchange. So a number of clients have actually found that they can't withdraw their funds. And right now, and then after that, FTX filed for bankruptcy. And as we start to see these bankruptcy filings come out, the records around it, we see that FTX may have as many as 1 million creditors, which is really a mind-blowing number. And the size of the hole may be as much as $8 billion or more. It's kind of the number that's the most often reported. But all of these facts are developing as we speak, so these numbers are due to change at any time.
I mean, I was also taken by, I mean, weeks before, in fact, a week before, there was positive stories about FTX and how great Sam Bankman-Fried was. And then, I mean, you and I were taken back by it. Everyone seems to be. What I don't understand is how Sequoia Capital could have such a large stake in them and not run the due diligence and find out all these problems. Because when Binance spent just 24 hours looking at the balance sheets, they pulled out of potentially taking over because it was so dodgy. How was this not noticed? Was there no one betting against FTX beforehand? Because I also heard that apparently they didn't even hold the cryptos that apparently were being exchanged within the exchange. They just had it on a Google Doc sheet and they would say how much people would have. So how was this not noticed by anybody?
Well, I mean, that's, of course, a pressing question right now that everyone's asking. It seems like many reputable investors that are responsible for some of the biggest companies, biggest tech companies around, that they were also investors into FTX. And how did they not notice this? And the only explanation that seems likely is that in the mania that was going on as crypto prices were just climbing, and it was becoming, many investors felt like they had to get in quickly. And often investors, there were stories being reported of investors, large venture capitalist investors, sometimes investing within 24 hours. That's not enough time at all to do a due diligence. And so it seems like FTX and Sam Bankman-Fried took advantage of this environment and raised a lot of money without the necessary due diligence around their controls, etc., that should have been in place for an exchange. If this had not been a crypto exchange, but let's say a stock exchange, then these controls would have had to been in place in order for that exchange to have a license. And so what you also see is the fact that these crypto exchanges were unregulated. It really allowed anything to go. But you're quite right that these kind of blue chip investors should have actually looked into this and realized that the controls were sorely lacking.
Yeah, it's obviously now spread over to the broader market as well. I mean, other exchanges had to freeze withdrawals because there were bank runs there. The price of cryptocurrencies dropped substantially all along the board. I think I've got a figure here. It's the 15 largest cryptocurrencies lost $152 billion in market value in 3 days, which is huge. Is this like the Lehman Brothers of the crypto world? And what does it mean for future exchanges and cryptocurrency as a whole?
Yeah, so I mean, you see the huge amount of market value that's been wiped out. However, this kind of failure wasn't related to leverage, at least not directly. It seems to be related to fraud, poor controls, as we talked about, conflicts of interest, because Sam Bankman-Fried also owned a large hedge fund, Alameda Research, and it seems like there were transactions between these two entities that were not done on an arm's length basis, and what might even be outright theft. Now, the reason I bring this up is that when we've seen previous collapses, the leverage, and also with Lehman Brothers, the leverage resulted in other collapses happening as well. Whereas in this case, it doesn't seem to be the case that there is a lot of tokens locked up that will have to be sold as collateral, which will result in more selling pressure and the values dropping further. So what a lot of crypto commentators are saying is that this is probably the event that marks the bottom for the crypto market, that being really sell pressure. Um, so the initial sell pressure of that $150 billion was due to people's loss of confidence, as opposed to people forced sellers in terms of leverage. That being said, I don't think that this is the last collapse we're going to see. That's because many different exchanges and other institutions had their deposits with FTX. And that just speaks to how much everyone trusted FTX. Um, and so the question, though, is why did these institutions have their deposits with FTX? Now, when it comes to hedge funds, they're trading all the time, and so they need to maintain crypto balances on exchanges so that they can move in and out of different cryptocurrencies. However, when it comes to other exchanges, it really begs the question, why did they have deposits on FTX? And what's likely the case is that these exchanges had deposited cryptocurrency on FTX in order to earn interest on it. FTX was paying yield on it. And sometimes this was undisclosed to their customers. Sometimes where it was disclosed, they were not passing back the interest that they were earning. So they were taking risk with customer money, but not passing it back on to the customers. And so what we're likely to see is other exchanges collapse if and when customers start to try and withdraw money and hence have another bank run on those exchanges. And it turns out that they don't have the assets they need to pay back the customers all of their funds as they withdraw it. So it's likely that we're going to start seeing more and more of these exchanges collapsing. However, again, they're probably not going to be forced sellers, as I described earlier. And one of the big ones in the US is a company called Genesis. And Genesis is Prime Broker, which is a kind of institution that interacts with big institutions. They often act as a buyer and seller. They often lend them securities or crypto in this case. And Genesis also then paused their withdrawals. And Genesis is part of this big group called the Digital Currency Group, which has companies all over the world, including here in South Africa. And so we can see this is one example of the kind of contagion effect of other institutions now having exposure, them potentially collapsing. And then from there, the people that have lent them money or have money deposited with them then also find themselves with their financial position severely compromised.
How soon is this likely to spread over to local South African exchanges? And what can consumers do to protect themselves, like take the cryptocurrencies off of the exchanges? How would you go about that process?
Yeah, so that's a great question. I mean, how long it takes to spread is anyone's guess. It seems like when a lot of the institutions that blew up earlier in the year, in the first half of the year, it seems at that point Alameda Research had blown up then. However, because they were taking funds from FTX, no one knew. And so sometimes I think that when these exchanges, even in the world of traditional finance, or institutions find themselves insolvent, as long as no one knows, they carry on. And it takes an event for everyone to find out. Sometimes I guess the market turns in their favor and they make it back and then they're okay. However, it's only when people start trying to withdraw their funds that we then find out that they don't actually have the assets that they should have. And so really, I guess the question about will we find out and when will we find out if it's spread to South Africa, I think it's highly likely it's spread to South Africa. We'll only find out when customers actually start trying to withdraw their funds. And this thing makes, if an exchange is already insolvent, it makes it a bit of a self-fulfilling prophecy because the customers that get out first, they get all of their funds. And so it then actually precipitates a rush. Now, when it comes to crypto, it has this feature that you can take it into your own custody. You can take it off exchange. If you have shares of a listed company, you can't actually take those shares off the stock exchange. However, with crypto, you can. And that's one way for clients to protect themselves. However, it's quite risky to do so. It requires quite a bit of skill, actually, to do so. It's low risk in some ways. And we've discussed this before as well, self-custody. And the thing is that when you take crypto into your own custody, put it onto a device or onto your computer, and that's no longer on the exchange, you run the risk that that device breaks down, or you lose access to that device, or you forget the password. And unlike with an email account where you can just click forgot password and you get a reset message, that's not what happens with these wallets that save your cryptocurrency off exchanges. And it's estimated that about 20% of all cryptocurrency has been lost, where people have just lost access to it. They've forgotten about it. They can't get in. The device is broken, etc. Yeah, and one of the main reasons for loss as well is that often people pass away, and their heirs either are unaware that they even had this crypto, or they can't get into these devices, etc. And they can't actually recover the crypto, even if they are aware of it. And so self-custody provides a lot of challenges. However, for people who have the skill and the confidence to do so, then that's one option for them. For a lot of people that don't want to do that, that's why they've often left their coins and tokens on exchange. The other option is to use a professional custody provider, like Jaltech. We have professional custody services that we offer. And the beauty of that is that the coins are taken off exchange, and they are put into a place where there's no one has access to it except for the custody provider. The systems and processes in place, and we use the leading infrastructure provider in this space, a company called Fireblocks, which is one of the largest in the world. They also provide the custody infrastructure for the largest custodian in the world, the Bank of New York, which custodies 20% of the world's financial assets, not just crypto assets, financial assets. So very kind of so the gold standard in terms of technology and processes. And what we've done is kind of seeing all of this happening and being fearful about it coming to South Africa. We've actually, in order to try and protect investors in the market, we've provided a special offer to investors that for the next 6 months, any investors that come and custody the assets with us, we won't charge them any custody fees. And if they're unhappy with the service, they can withdraw it at any time during the 6 months with no withdrawal fees. So this should just allow investors to take their assets off exchange while this all plays out. The exchanges that are sound, they should be able to meet all withdrawals. And when this is all out of the system, we'll know that they're still sound. However, I mean, this whole thing kind of reminds me of what Warren Buffett said, that when the tide goes out, you find out who's swimming naked. And we definitely don't want investors to be exposed to the exchanges that are swimming naked.
How would people be able to pull, for instance, from an exchange, if they had 2 Bitcoin on an exchange, could they pull it off and give it directly to Jaltech for you to look after, or do you have to go directly through Jaltech to purchase the crypto?
No, so they could pull off their existing cryptocurrency. If they want, they could transfer directly from the exchange account to Jaltech's custody account. So that's one option. Or another option is if they do have a wallet, but they don't want to continue to keep things on their wallet, they could go from the exchange to their own wallet and then into Jaltech's custody.
So there's obviously no liquidity issues with Jaltech. How do these liquidity issues with the exchange come to be? How could people who maybe do want to keep it on an exchange, how could they check the liquidity of a company to make sure that they could pay out if they needed to? And now, if they are thinking of doing a bank run, how can they make sure that they'll be able to get their money out to, for instance, give it to a Jaltech? Yeah,
so I guess that when it comes to these exchanges, they are unregulated. And since this is such a new space, the checks are being developed as well. So one check, which is quite unsophisticated, is a proof of reserve. It's where an exchange actually proves that they control wallets that hold the level of cryptocurrencies that matches customer deposits. However, it's very easy to fudge these tests because it's possible that the next second they just transfer all those assets out. It's possible that it wasn't their assets and that someone's doing them a favor, or that it was just transferred in just for the moment of the test and then transferred out, etc. So the actual tests that prove that these entities have the deposits that they say they have are still being developed. However, a very crude measure for now is the proof of reserves measure. The exchanges have to voluntarily do this. A lot of the leading exchanges in the world have done so. They have published proof of reserves showing that they control large balances of cryptocurrency. But like I said, it's far from a foolproof proof.
I know just before the collapse, Sam Bankman-Fried said FTX had like $11 billion in liquid capital that they could pay out with, and that just obviously was not true. If CZ from Binance hadn't posted that tweet, hadn't pulled out of the deal, hadn't made it public that all this was going to happen, do you think things would have collapsed the way they have?
Well, it's difficult to say. There's, I guess, a few possibilities. The one possibility is that if no one had discovered this, and that depositors and withdrawals were roughly the same all the time, and the crypto market came back, maybe Alameda Research would have made a lot of money in the process, and it would have covered the hole. It's a very large hole, $8 billion, but maybe that would have happened. And maybe no one would have ever known. However, what could have also happened is that as FTX kept on attracting more customer money and growing bigger and bigger, it could have grown to 10 times its size or more, that the hole could have kept on growing. And if crypto assets had kept on moving against Alameda Research's bets, we might have been sitting with an $80 billion hole rather than an $8 billion hole. So, there's lots of speculation around what would have happened if CZ hadn't tweeted what he did and triggered the bank run. However, fundamentally, a bank run shouldn't have been possible. Even if every single customer of an exchange withdraws all their tokens and money, the exchange at that point doesn't have any revenue stream, so it won't stay in business for long, but it should have all the assets to pay out to the customers every single token and dollar.
And a turnaround time. So how long would you say before things potentially turn around, not back to the levels they were, but start heading in an upwards direction? Would you say now is a good time for someone to buy some cryptocurrency, maybe leave it with Jaltech, keep it in their own possession, or should you wait for another crash?
Well, so we can't offer any financial advice. However, there's a lot of factors at play here. I mean, the broader market had a bit of a rally because of some better than expected inflation data as this was all happening. And crypto, of course, didn't end up participating in that because crypto was going through this. However, what's interesting is that everything that's happened has in fact strengthened the case for crypto. And the reason being that what failed was a centralized entity that was actually unregulated. But even when it comes to banks and financial institutions that are regulated, they often do fail. And what crypto offers through decentralized finance and smart contracts, etc., is it offers an alternative where you don't need to trust human beings. You don't need to trust their judgment, their good intentions, their honesty, their processes and controls. It's all built into code. And that code is available for everyone to see. This doesn't mean that there haven't been hacks in the past, etc. However, anyone can try and spot the holes in the contracts and then fix them. And a lot of these protocols have been going for a long time now with no hacks, proving that lots of people have been trying to hack them, proving that they're probably safe. And when it comes to those protocols with the billions of dollars that have been deposited in there, there's no human being that can take the money out and steal it. And so if anything, this has actually strengthened the case for crypto and the technology of blockchain. And so people who believe in that are saying that this is a really great time to buy. Prices are depressed not because the Ethereum chain failed, not because someone managed to double spend a Bitcoin. No, that's not the case. And if anything, this technology needs to be deployed more widely to prevent the failure of financial institutions in the future. And so these are quite low prices compared to the all-time highs previously. And so it is seen as a buying opportunity, of course, to then quickly take off exchange and put into custody.
Well, to learn more about the Jaltech and its services offered, click on the link in the description below. Thank you once again, Gaurav.
Thanks for having me, Ross.